Disclaimer. June 18, 1815, 11 p.m. A battlefield courier departs the ridge of Mont Saint-Jean. He carries no weapon, only a secret. His destination, the London banking house of Nathan Mayer Rothschild. 24 hours later, a financial ambush was sprung. The British government was paralyzed. The London Stock Exchange was cornered. One family netted a profit equivalent to over $1 trillion in today's money. In a single day, they didn't win the battle. They won the information war. And in doing so, they perfected a pattern of financial control that has dominated global economics for 2 centuries. This is not the story of a banking family. This is the story of the information standard, a system where knowledge of events, before the public, before the state, is the ultimate currency. A system that has enabled private capital to outmaneuver, outlast, and ultimately capture sovereign nations for over 200 years. From Waterloo to the Weimar Republic, from the 2008 collapse to the digital age, the pattern repeats. A silent coup executed not with bullets, but with bonds. Not with declarations of war, but with whispers of debt. The framework is a 5-stage capture, a blueprint for financial sovereignty. Stage 1, the information monopoly. Control the flow of capital-critical intelligence. Stage 2, the sovereign trap. Lend to governments in existential crisis. Stage 3, the currency anchor. Tie national currency to an asset you influence. Stage 4, the debt spiral. Structure sovereign debt to be perpetual and expanding. Stage 5, the silent default. Trigger a controlled demolition of the old system, transferring real assets to private hands. This is the pattern that built empires of capital, not British, French, or American empires. A borderless empire of credit. It operated under the pound sterling. It migrated to the US dollar. And for the last 50 years, it has perfected its mechanisms within the modern financial system. The Rothschild-Waterloo trade was not an isolated genius. It was stage 1, the opening move, the proof that a private network could move faster than the state itself. That pattern is now complete, and the global sovereign debt market, valued at over $100 trillion, is the final battlefield. This is how financial dominance is engineered. This is how it ends. And you are living through the final act, the rise of the fifth estate. To understand the Waterloo trade, you must first understand the weapon, not the cannon or the cavalry, the communication network. By 1815, the House of Rothschild was no mere bank. It was the first true multinational corporation, a private, borderless intelligence agency with a balance sheet. The rise was methodical, brutal, and shockingly fast. 1760s, Mayer Amschel Rothschild establishes the Frankfurt House, financing landgraves and trading rare coins. 1800, he sends his 5 sons to Europe's key capitals, Frankfurt, Vienna, London, Naples, Paris. 1806, Napoleon's conquests disrupt traditional state financing. The brothers position themselves as neutral financiers to all sides, a family at war with itself, for profit. 1814, Nathan Mayer Rothschild in London single-handedly finances the British shipment of gold to Wellington's armies, beating the Treasury's own channels. He moves £800,000 in gold, over $100 billion today, across a war-torn continent. The state is now a client. By June 1815, the Rothschild network was the fastest information system on Earth. They employed their own fleet of couriers, ships, and agents. They used a private cipher. They bribed officials at every border. Their speed made the official state postal services look medieval. The British government relied on newspapers. Nathan Rothschild had a direct line to the battlefield. The fatal decision: the state outsources its nervous system. The turning point was not a battle. It was a delegation. Exhausted and indebted from the Napoleonic Wars, European governments made a critical error. They outsourced the lifeblood of sovereignty, the raising of capital, and the transmission of critical intelligence. They saw the Rothschilds as efficient contractors. They failed to see they were ceding the high ground of information. When the Duke of Wellington and Napoleon Bonaparte faced off at Waterloo, 2 armies clashed. But a third party held the most powerful position, the observer with a direct line to the markets. Nathan Rothschild had an agent named Rothworth on the edge of the battlefield. The moment the French formation broke, Rothworth raced for the channel. He carried a single note in cipher. On June 19, 1815, a Rothschild schooner docked at Folkestone. Nathan received the news. Napoleon has been decisively defeated. He had at least 24 hours before Wellington's official envoy reached London. The British government was blind. The market was blind. One man could see everything. The fatal decision was already made. The state had sacrificed its informational sovereignty for financial convenience. The trap was set. All that remained was the spring. Nathan Rothschild walked onto the floor of the London Stock Exchange the morning of June 20th. He did not buy. He began to sell. He sold British government consols, bonds, with a visible desperation. The signal was clear to every other trader. Rothschild knows. Waterloo is lost. The British government is finished. A panic ignited. The floor descended into chaos. Consols plummeted. As prices cratered, Rothschild's agents, hidden in the crowd, began to buy. They bought every bond they could, for pennies on the pound. By the time the official news of victory arrived the next day, jubilating the public, Nathan Rothschild had secured a dominant position in British government debt. The profit was legendary. The precedent was catastrophic. A private entity had manipulated the state's credit by weaponizing asymmetric information. They told you it was a story about a clever speculation. The truth is, it was a demonstration of a new power principle. The state no longer controlled its own financial destiny. It had a partner who saw first, moved fastest, and answered to no parliament, no king, no people. The five-stage capture ***. The Waterloo trade was not the endgame. It was the proof of concept. It revealed a five-stage pattern for capturing the financial sovereignty of nations. This is the blueprint. It has been followed, with chilling precision, for over 2 centuries. Stage 1. The information monopoly. Control the capital critical intelligence. Be the first to know. Money flows to where it is treated best, but it flees at the speed of information. The entity that sees the crisis first wins. Historical example 1. Rothschild and Waterloo, 1815. The family's private courier network provided a 24 to 48-hour advantage over the British state. This wasn't just news. It was the ultimate insider trading signal on the survival of the British government itself. Nathan's theatrical sell-off was the manipulation that turned information into unimaginable wealth. Historical example 2. J.P. Morgan and the Panic of 1907. As banks failed, Morgan's bank became the clearinghouse for all critical information. He summoned bank presidents to his library, locked the door, and forced them to disclose their positions. Only he had the complete picture. The U.S. Treasury Secretary had to beg him for data. Morgan didn't just have information. He was the information system for the American economy. His private actions dictated public policy. Historical example 3. The 2008 financial crisis. Major investment banks like Goldman Sachs, using complex derivatives and their central position in the mortgage market, had asymmetric data on the toxicity of subprime debt. They continued to sell mortgage-backed securities to clients while simultaneously betting against them. The information was not illegal, it was monopolized. The government and public were in the dark until the collapse was unavoidable. Stage 2. The sovereign trap. Lend to governments when they are most desperate, during war, revolution, or existential crisis. The terms are never favorable to the state. The debt is structured to be perpetual. Historical example 1. Rothschild and post-Napoleonic Europe, 1818 to 1822. After Waterloo, European governments were bankrupt. The Rothschilds issued the first international sovereign bonds, bailing out Prussia, Austria, and France. They didn't just lend money, they became the credit rating agency. Their influence dictated whether a nation could access capital, effectively deciding its geopolitical fate. Historical example 2. Morgans and Britain in World War I, 1915. By 1915, Britain was running out of gold and credit to fund the war against Germany. The UK Treasury turned to J.P. Morgan Jr., appointing the bank as its sole commercial agent in the United States. Morgan organized a $500 million loan, roughly $15 billion today, the largest foreign loan in history at the time. America was neutral, but Wall Street, through Morgan, was financing the Allies. The state's war machine was now dependent on private syndicates. Historical example 3, the IMF and the Asian financial crisis, 1997 to 1998. When speculative attacks crashed the Thai baht and South Korean won, the International Monetary Fund stepped in with bailout loans. The conditions, structural adjustment programs, forced austerity, privatization of national assets, and capital market liberalization. Sovereign policy was dictated by creditor terms. The trap was sprung under the banner of rescue. Stage 3, the currency anchor. Tie the national currency to an asset you can influence, control, or create. Gold. The US dollar. Debt itself. This turns the medium of exchange into a lever of control. Historical example 1. The gold standard and the London gold market. Throughout the 19th century, the classical gold standard reigned. The Bank of England, with its deep ties to the Rothschild-led London gold market, effectively set global gold prices and flows. A nation's money supply was dictated by its gold reserves, which were often financed and shipped by the very private banks that set the terms. Historical example 2, the Bretton Woods system, 1944 to 1971. The US dollar, backed by gold, became the world's reserve currency. All other major currencies were pegged to it. This system was managed by central banks and the IMF, but its stability depended on Wall Street's ability to provide dollar liquidity through the eurodollar market, a private, offshore banking system that grew beyond any state's control. The anchor was public, the mechanism was private. Historical example 3, the petrodollar system, 1974 present. After Nixon ended gold convertibility in 1971, a new anchor was needed. The 1974 U.S.-Saudi agreement mandated oil sales in U.S. dollars, recycled through Wall Street. The dollar's value was now anchored to the global demand for energy. Any nation needed dollars to buy oil, propping up dollar demand and allowing the U.S. to run massive deficits. The anchor was a commodity, but the spigot was controlled by geopolitical deals enforced by banking networks. Stage 4, the debt spiral. Structure sovereign debt so it can never be paid off, only rolled over and expanded. Debt becomes a permanent feature of the state, and the private creditors become permanent beneficiaries of its tax revenue. Historical example 1, the consolidation of British perpetual debt, 18th to 19th century. After the Napoleonic Wars, Britain's debt to GDP soared above 250%. Much of this was in consols, consolidated annuities, perpetual bonds with no maturity date. The state committed to paying interest to bondholders, like the Rothschilds, forever. A significant portion of the British budget was permanently transferred to financial elites. Historical example 2, the U.S. Treasury market and the debt ceiling theater, 1980s present. Since the 1980s, U.S. federal debt has grown exponentially, from $1 trillion to over $34 trillion. Major primary dealer banks, like Goldman Sachs, J.P. Morgan Chase, are legally obligated to bid at Treasury auctions. They profit from the spread, the fees, and the use of treasuries as collateral for their own leveraged bets. The debt ceiling crises create volatility they can trade. The system is incentivized to grow the debt, not solve it. Historical example 3, Japan's quantitative easing, 2001 present. The Bank of Japan, BOJ, now owns over 50% of all Japanese government bonds. This is a debt spiral managed by the state itself, but the ultimate buyers are financial institutions. It creates a carry trade paradise for global banks, who borrow cheap yen to invest elsewhere. The debt is immortal, and the financial sector harvests the arbitrage. Stage 5, the silent default. When the debt spiral becomes unsustainable, a controlled demolition occurs. The old obligations are vaporized not through a formal declaration, but through financial engineering, inflation, currency devaluation, or asset confiscation under new rules. The real assets are transferred, and a new cycle begins. Historical example 1. The Weimar hyperinflation, 1921 to 1923. Germany's war debts and reparations were unsustainable. The Reichsbank, influenced by commercial bank interests, printed money to buy foreign currency and pay debts. The result? Hyperinflation. Savings and bonds were wiped out. The real assets, factories, land, were purchased for pennies by speculators and industrialists with hard currency or foreign credit. The debt was erased. The assets changed hands. Historical example 2. The Nixon Shock and the end of gold convertibility, 1971. The U.S. defaulted on its Bretton Woods promise to redeem dollars for gold for foreign governments. It was a silent default on its sovereign obligation. The value of dollars held overseas plummeted. Those holding gold won. Those holding dollar-denominated debt lost purchasing power. The rules of the system were unilaterally changed to preserve its core. Historical example 3. The Cyprus bail-in, 2013. When Cypriot banks failed, rather than a traditional taxpayer bailout, the EU enforced a bail-in. Uninsured deposits, over 100,000 euros, were forcibly converted into bank equity, effectively confiscated to absorb losses. It was a silent default on bank deposits, a template for transferring loss from the financial system directly to the saver. The precedent was set. Bank liabilities can be restructured by decree. Current crisis application. The pattern is not a relic. It is an operating manual. And the evidence is no longer hidden in 19th century ledgers. It is on the public balance sheet, in the digital feeds, in the desperate rhetoric of central bankers. We are at stage 5, the silent default. Right now, the sovereign debt spiral has reached terminal velocity. The information monopoly is algorithmic. The currency anchor is corroding. The trap has been sprung on a planetary scale. The controlled demolition is underway. Current evidence, the stage 5 indicators. The debt unsustainability. Global sovereign debt surpassed $100 trillion in 2023. The United States alone adds $1 trillion of debt approximately every 100 days. The interest payment on the U.S. national debt is now over $1 trillion annually, more than the entire defense budget. The spiral is mathematically irreversible. The monetary demolition tool, quantitative easing, QE, to quantitative tightening, QT, and back. Since 2008, central banks have created over $25 trillion out of thin air to buy bonds, QE, artificially suppressing interest rates and inflating asset prices. They are now attempting to reverse it, QT, but the market fractures instantly. The 2019 repo crisis and the 2023 U.S. regional banking collapses were tremors. The system cannot function without permanent, massive central bank support. This is the silent default in slow motion, devaluing currency to manage unpayable debt. The weaponization of the information standard, the flash crash of 2010, the GameStop short squeeze of 2021. These are not anomalies. They are symptoms. High-frequency trading firms, operating with millisecond advantages and complex algorithms, are the new Rothschild couriers. They see flow, they predict reactions, and they front-run the entire market, including pension funds and retail investors. The information monopoly is now fully automated, hosted in servers closer to the exchange than you can ever be. The erosion of the currency anchor, de-dollarization, is not a fringe theory. It is a central banking strategy. Russia and China have over 40% of their bilateral trade settled in yuan/rubles, not dollars. BRICS nations are openly developing a new settlement system. Gold purchases by central banks, China, Poland, Singapore, hit a 55-year high in 2022 to 2023. They are quietly moving away from the dollar-based debt anchor, seeking a harder asset. The anchor is slipping. The bail-in template is law. The Cyprus precedent was codified. The U.S. Dodd-Frank Act, Title II, and the EU's Bank Recovery and Resolution Directive, BRRD, establish frameworks for bail-ins. Uninsured deposits and certain creditors can be forced to absorb a bank's losses. Your bank account is no longer a safe deposit box. It is an unsecured loan to a highly leveraged institution. The mechanism for the silent default on savings is legally prepositioned. The catalyst: COVID-19 and the Great Fiscal Surge. March 2020. The pandemic lockdowns. This was the Stage 5 catalyst. It provided the political cover for the final, breathtaking expansion of the debt spiral. In 24 months, the U.S. Federal Reserve expanded its balance sheet by over $5 trillion. The U.S. government injected over $8 trillion in fiscal stimulus. The entire developed world followed suit. They told you it was a rescue. The truth is, it was the final acceleration. It pulled all future demand forward, exploded inflation, and made the interest rate trap inescapable. Every central bank governor knew it. The choice became: collapse the bond market by raising rates to fight inflation, or collapse the currency by printing to service the debt. They chose to fight inflation first, knowing the debt pain would force them to reverse course. This is the controlled demolition playbook. Create the crisis. Manage the collapse. Transfer the assets. Stage 5 indicators in your life now. Inflation as policy. Core inflation remains structurally above the 2% target. This is not an accident. It is a tool to erode the real value of the $34 trillion U.S. debt. A 4% inflation rate halves the real value of that debt in 18 years, without a single vote in Congress. The loss of monetary sovereignty. The Fed is independent until it isn't. In 2020, it directly financed government spending by buying treasury bonds at a pace that matched issuance. This is monetization of debt, the ultimate silent default mechanism. The wall between monetary and fiscal policy is gone. The rise of the CBDC trap. Central bank digital currencies are marketed as convenience. Their architecture is about control. Programmable money. Expiration dates on stimulus. Direct tax collection. The ability to enforce negative interest rates on everyone by decaying the digital currency in your account. This is the information monopoly and sovereign trap combined into a single digital system. The geopolitical weaponization of finance. The freezing of Russia's $300 billion in central bank reserves in 2022 was a watershed. It proved to every nation that dollar assets held abroad can be confiscated by political fiat. It forced the search for an alternative system, accelerating the very collapse it sought to prevent. The everything bubble. Stocks, real estate, art, collectibles. When the currency itself is being devalued, hard assets and speculative vehicles soar. This isn't prosperity. It is the frantic flight of capital from a failing system, inflating bubbles that will burst when the liquidity is finally pulled. The Stage 5 silent default is not a single event. It is a process. It is the 8% inflation that stole your wage growth. It is the bank bail-in clause buried in your account agreement. It is the trillion-dollar interest payment your taxes can't cover. It is the slow, systematic transfer of wealth from those who hold currency to those who hold power, assets, and the means of production. The Rothschilds used a schooner and a cipher. The modern system uses blockchain, AI, and central bank digital ledgers. The principle is identical. The pattern is complete. The question is no longer about diagnosis. It is about consequence. Consequences and timeline ***. The Great Transfer. When a system enters Stage 5, the goal is no longer preservation. It is transfer. The silent default is a wealth vacuum, pulling real assets from the periphery of the economy to its fortified core. History shows us the winners and losers with brutal clarity. What this means: winners and losers. For the winners ***. The asset holders ***, those with direct ownership of non-financial, income-producing assets, productive land, energy infrastructure, commodity reserves, core urban real estate, and controlling stakes in essential technology. Debt devaluation makes their assets more valuable in nominal terms, while their real property endures. The 19th century Rothschilds didn't just hold bonds. They bought railroads, mines, and real estate across Europe with their profits. The primary dealers and system architects *** the largest global banks, JP Morgan Chase, Goldman Sachs, etc., and asset managers, BlackRock, Vanguard, that serve as the plumbing of the financial system. They profit from volatility, manage the debt auctions, and will be first in line to manage the restructuring and asset sales. In the 2008 crisis, they were not destroyed, they were consolidated. Sovereigns with hard asset balance sheets * nations like China, massive holder of commodities and manufacturing plant, Russia, energy and commodities, and Saudi Arabia, Aramco, transition from dollar reserve holders to owners of the physical means of production. Their strategic leverage shifts from financial to tangible. The private creditor class * those who hold debt not as a fixed income investment, but as a lever of control with covenants that allow them to seize underlying collateral in a default event. Distressed debt funds are already positioned for this, waiting in the wings like vultures. For the losers *, the fixed income pensioner * anyone relying on bonds, annuities, or fixed pension payments. Inflation eviscerates their purchasing power. The income is fixed, but its value is not. This is the Weimar widow writ large across the entire developed world. The uninsured saver * the individual with cash deposits above the insured limit in a fragile bank. They are the explicit bail-in candidate, the first layer to be converted to worthless equity in a resolution. Cyprus was the drill. The middle-class asset owner * the homeowner with a massive mortgage, the 401k investor heavily indexed to overvalued financial assets. They believe they own assets, but they are highly leveraged participants in a bubble. A deflationary crash destroys their equity. An inflationary spiral destroys their debt burden, but crushes their cost of living. They are caught in the pincer. Nations with high dollar-denominated debt * emerging markets that borrowed in US dollars will face an impossible trinity as the dollar strengthens during crisis. Service crushing debt, import essential goods, and defend their currency. Sri Lanka, 2022, was a preview. Many will follow. The taxpayer * the ultimate backstop. As debt service consumes budgets, austerity for public services, education, infrastructure becomes permanent. Taxes will rise on visible income, even as wealth escapes via less visible assets. The citizen pays for the demolition. Projected timeline, based on historical precedents. The silent default is a process, not a day. But processes have tipping points. Using the historical arc from the Nixon Shock, 1971, as our modern baseline, a 50-plus year period of fiat debt expansion, we can project the final sequence. 2025-2030, the contagion and control phase. * rolling currency and sovereign debt crises hit peripheral nations, Japan, UK, select EU members, as debt service consumes greater than 30% of revenue. * central banks are forced to halt quantitative tightening, QT, and restart QE in response to market breaks, openly monetizing debt once more. * capital controls emerge in vulnerable economies. The IMF is deployed constantly, enforcing brutal austerity. * key event * a major developed nation, e.g., Italy, experiences a failed bond auction requiring direct, permanent ECB monetization. The rulebook is torn up in plain sight. 2030-2035, the fracture and formalization phase. * the bipolar or multipolar financial system hardens. A US/Euro-Japan bloc continues with a heavily managed, digital-leaning dollar system. A China-Russia/BRICS plus bloc operates on a commodity-backed, digital settlement platform. * central bank digital currencies, CBDCs, are launched in major economies, first as optional, then as the primary conduit for government payments and benefits, creating a two-tiered currency system. * a significant bail-in event occurs at a major Western bank, wiping out uninsured deposits and certain bondholders. Public outrage is met with technocratic justification. The system was saved. * key event * the US or EU formally institutes a wealth fund, or uses emergency powers to mandate the purchase of strategic assets, energy grids, tech infrastructure, from distressed sellers, centralizing control. 2035-2050, the new standard emerges. After a period of extreme volatility, a new de facto benchmark emerges. It will not be a return to a gold standard. It will be a digital asset basket standard. Central bank digital currencies will be exchangeable for a basket of digitized assets, treasury bonds, maybe gold certificates, and perhaps shares in sovereign wealth funds. Your money will be a direct claim on a state-managed portfolio of assets, with its value algorithmically adjusted. Financial sovereignty will be fully redefined. Privacy in transactions will be a premium luxury good. Capital allocation will be directed by policy algorithms. The winners of the transfer phase will see their holdings legitimized and cemented into this new structure. The cycle will begin anew, with a different set of tools, under a different informational paradigm. The bottom line. The pattern is clear. It is a cycle of capture, expansion, and controlled demolition. From the Rothschild courier to the Fed's swap line network, the principle is unchanged. Those who control the information and credit architecture of an era dictate its outcomes. The 1815 Waterloo trade was the spark. The 1971 Nixon shock was the point of no return. The 2008 crisis was the desperate reinflation. The 2020 pandemic response was the final acceleration. We are now in the long, chaotic unwind of a 50-year debt supercycle. The question isn't if the current system resets. It is how. History's lesson is that the reset always benefits the architects and the asset holders, while formally liquidating the promises made to the previous era's savers and pensioners. The silent default is happening in your purchasing power, in your bank's terms of service, in your government's budget. It is $1 trillion a year transfer, hidden in plain sight. The Rothschild principle endures. He who creates the standard wins the game. The next standard is being built right now. Not in granite, but in code. We have traced a pattern. From the smoke of Waterloo to the digital feeds of modern finance. A pattern of information, debt, and sovereignty. This analysis connects historical dots to reveal a framework that has shaped our world for 2 centuries. But a framework is not a fortune teller. The purpose of this narrative is not to predict a specific day of collapse or to incite panic. It is to provide a lens, a diagnostic tool forged from economic history, to show that what feels chaotic and unprecedented often follows a worn path, to argue that financial power has its own logic, its own life cycle, and its own relentless patterns. Recognizing the pattern is the first step in navigating it. Whether you are an investor, a citizen, or simply a student of history, understanding these forces is your only defense against the myth of inevitability. The past shows us the mechanisms. The future is still written by human choices, by policy, and by unforeseen events. Disclaimer. This video is for educational and informational purposes only. It presents historical analysis, opinions, and interpretations based on publicly available sources and academic research. It is not financial advice, political advice, or a prediction of future events. All historical comparisons and references to modern institutions, governments, or market events are theoretical frameworks for analysis. They should not be interpreted as claims of certainty, accusations of illegality, or endorsements of any specific course of action. The examples of the Rothschild family, J.P. Morgan, and modern financial institutions are used to illustrate structural patterns within capitalist and state systems. This video does not allege any current illegal conduct by these or any other entities. Viewers are strongly encouraged to research these topics independently, consult with qualified financial and legal professionals for personal advice, and draw their own conclusions based on a plurality of sources. The future is not set. History only rhymes. Your awareness is the first and most important capital you possess.